Welcome to Taking Stock for the week ending the 5th of August 2022. I'm Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. I know it's quite a busy time for us, but really appreciate you taking the time out today to share your insights, Jace.
It's my pleasure as always, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented today shouldn't be relied upon as a guide for future performance. Well, the Australian full-year reporting season is underway, and so far, most of our star stocks have performed well, including Pinnacle Investment, BWP Trust, Genworth Mortgages, and Rio Tinto. And meanwhile, we hope the better-than-expected second quarter US reporting season will translate here in Australia. So far, 73% of the S&P 500 companies have beaten market expectations. And many growth stocks like Apple, Alphabet, and Microsoft, they've reported stable revenue and margins. And this is leading to a strong recovery in the US tech index, the NASDAQ, and also the S&P 500. Only this week, PayPal, an online payments platform, raised their full-year earnings guidance.
But market sentiment has not only been driven by the better than expected results. For example, the US services sector, which accounts for more than 2/3 of economic activity, had rebounded in July, and this was on the back of strong order growth and easing supply chain pressures. Furthermore, cost inflation has also eased in July with an improvement in supplier deliveries. Hopefully, the easing of these pressures can provide a near-term tailwind for earnings for the Aussie companies reporting this season. Meanwhile, a decline in oil price to below $90 a barrel should help cool inflationary concerns over the coming months, and this could provide some respite from central bank interest rate hikes. The Australian cash rate is now at 1.85%, and this was after a 50 basis point increase by the RBA earlier this week. The RBA also trimmed back their economic forecast for 2023 GDP growth of 1.75% instead of the 2% originally anticipated.
Yes, Jace, quite interesting, but really the point to note here is that the economy continues to grow, only at a slower pace. Meanwhile, rising debt costs will continue to put pressure on financially weak businesses. Take, for instance, with Mesoblast, a financially unhealthy biotech company that develops cell rejuvenation technology. This sounds like a great investment thesis, but unfortunately this week, this unprofitable company went into trading halt to raise cash, and which it has done time and time, year after year since listing. And to rub salt into investors' wounds, these raisings also contribute to the CEO's excessive remuneration structure at $2.66 million. And last week, the company reported US $90 million in debt, with only about $60 million of cash on the balance sheet.
So aside from some of these financially unhealthy companies, we continue to keep a close eye on the retail sector, as it's also highly sensitive to interest rate rises. Reassuringly, economic data released this week showed that Australian trade volumes rose 1.4% in the June quarter. While this data has been better than expected, investors need to be mindful that it is backward looking and that the full impact of interest rate rises, which actually began in May not be represented in this data set.
But one thing I saw within that retail data, Jace, is that investors should really be wary of food and household goods, which did reveal a drop in sales volume for the quarter. And this can be seen with the table on screen. Some of our star stocks that lie in this area include star growth stock Domino's Pizzas, borderline star growth stock Breville Group, star income stocks JB Hi-Fi and Adairs. Investors really need to be comfortable with these risks as we head into their results, although JB Hi-Fi did recently provide a positive fourth quarter update a few weeks ago.
Right, so talking about star stocks, another company that was able to defy the odds of rising interest rates was star growth and star income stock Genworth Mortgage Insurance. Being a provider of lenders' mortgage insurance, investors were concerned about a slowdown in the home loan market, as represented by a steep decline in Genworth's share price over the past few months. However, the company was able to improve on its return on equity and net profit margins, rising to 21% and 67% respectively.
Yeah, but all is not what it seems here. The result was driven by what we call accrued revenue earned from previously written insurance. And this is referred to as gross written premiums. This business was written when interest rates were at record low levels. In addition, you have low unemployment rates, helping borrowers meet their mortgage repayments and also help keep claims quite low. And to understand current operating conditions, you really need to look at the current gross written premiums, which is down 35% on year. Think of this as the work in hand. Eventually, the revenue from this pipeline will be recognized in the next period, with forward earnings growth rates expected to decline in the next 2 years. Investors should also note the uncertainty around earnings forecasts, given that there are only 3 analysts providing estimates.
Rising interest rates and the slowdown in the housing market remain heightened active risks and could potentially derail its star growth status. Income investors should also consider these risks and assume a more conservative estimate of the gross dividend yield, which is currently around 13%, and this is on the back of a rising payout ratio. The stock is expected to go ex-dividend on the 16th of August.
Yes, and we're currently assessing this high risk on the stock to see whether it can be retained its star income stock status. And another star growth stock and star income stock that performed well during the week was Pinnacle Investment Management. The company is a funds management business and generates fees from its ownership stake in boutique fund managers. The business was able to generate an 8% rise in earnings on the back of higher management fee margins and recent acquisitions, including private equity firm 5V Capital. Unlike other fund managers, the company reported positive fund inflows for the full year despite challenging market conditions.
So despite this, the company reported a decline in ROE from 30% to 24% due to the dilutionary impact of the equity raise in December 2021. The outlook remains challenging, with forecast earnings being revised down by double digits over the last 3 months. As a result, we have removed the company from our star growth universe.
And from an income perspective, the gross dividend yield is around 4%, which is currently on par with the market yield. We believe, though, that this doesn't really provide enough margin in the event forecast dividends may be downgraded on the back of continuing challenging market conditions. The stock, of course, goes ex-dividend at the end of August for those who want to receive the dividend. Now, looking ahead with the reporting season in full swing, there will be results from Suncorp, Charter Hall Longwell REIT, REA Group, Commonwealth Bank, Arena REIT, Telstra and ResMed. Star income stocks, Rio Tinto and Suncorp, they will be going ex-dividend next week.
And in terms of technical alerts, for those who are trend sensitive, stocks that turned bullish on the SDMAX included LTM, BWP Trust, Charter Hall Social Infrastructure, Domino's Pizza, Lovisa Holdings, and Super Retail Group. Meanwhile, the following stocks triggered a re-entry on the SD30 TSR: Alkane Resources, Cogstate Limited, DDH1, IDP Education, and Macmillan Shakespeare.
In Under the Microscope this week, we take a closer look at Credit Corp. The company's operations center around the collection of bad debts or purchase debt ledgers. These debts are purchased from the original credit provider, typically banks, telecommunications providers, and also energy providers, for a fraction of its worth. And the business also provides short-term unsecured high interest rate loans to consumers as well.
So the company's share price was sold down on the day of the result because management guided for a 3% earnings decline in FY23, and this was compared to market expectations for around 6% growth. Management pointed to ongoing labor challenges in the US and along with a mature purchase debt market in Australia and New Zealand, which impacted the outlook.
And with market expectations now rebased, the dividend payout ratio of less than 50% remains unstretched. Hence, we believe the above market yield of 5% remains sustainable. But with heightened active risks around a slowdown in the global economy, many investors are wondering whether rising interest rates and the flow-on effects this could have on debt collection.
And this is a pretty valid question, Kien, because it really is a double-edged sword. Slower economic growth and rising interest rates could potentially lead to the supply of more bad debts. and this would allow Credit Corp to purchase them cheaply. However, it becomes more difficult for the company to get consumers to repay on those debts.
Yeah, but in the end, the business is about making consumers pay back their loans. And in a severe market downturn, this becomes the key issue. For now, though, we retain the stock in coverage, but continue to monitor this risk quite closely, especially given that forecast earnings revisions have begun to roll over. But the environment remains quite supportive with low unemployment rates. Meanwhile, management have implemented risk management strategies to manage default risk by not overpaying for bad loans, for instance, and running credit checks on borrowers. Furthermore, Credit Corp has a long track record of adopting conservative guidance at the start of the year.
So for trend-sensitive investors, they should remain on the sidelines because the stock is trading in a bearish zone on the SD Max and also triggered an exit on the SD30 TSR. The stock is also trading at a slight discount to its consensus share price, but those who consider this as an opportunity should be comfortable with the active risks, especially given that the stock is highly leveraged to economic conditions.
With reporting season in full swing, it's important for investors to ensure their portfolio holdings are updated in the portfolio manager. But entering each stock manually from your broker can be an arduous task. So the question this week is, how can investors import their portfolio holdings into Stock Doctor? As part of our commitment to constant innovation, we've recently introduced an import trades function within the portfolio manager. And this tool really makes updating the stocks in your portfolio much easier.
It sure does, Kien. So whether you're bringing in a new portfolio or updating an existing portfolio, we have separate instructions for how to do this. For further clarification, please refer to our Help Center, and here you'll find an exclusive help video along with written instructions.
And once the holdings come through, make sure you go through each security to ensure your data is consistent with those from your broker. You may need to make some manual edits as well, especially with regards to recent mergers and acquisitions, spin-offs, bonus issues, or even dividend reinvestment plans.
So the benefits of having an updated portfolio is that it allows you to take advantage of all the features within Stock Doctor, including links to the corporate calendar, the portfolio optimizer, reports, watch lists, and the charting tool.
Thanks, Jace, for your time again. I know you're very busy during this reporting season.
Thanks, Kien. Thanks for having me.
Also, a reminder to join our Lincoln Live on Monday, where our portfolio manager, Matthew Swartz, our Stock Doctor expert, Rob Manfrey, and of course myself will be there to answer any questions you have, especially now that we're in the midst of reporting season. But to summarize, many growth stocks have been able to defy rising interest rate concerns and are reporting stable revenue and margins. And with oil prices falling, there is a chance that inflationary cost pressures could ease and company outlook guidance be sustained. So take advantage of opportunities this reporting season as long as you are comfortable with the active risks. Take care and have a happy, healthy, and prosperous week, everyone.